Well, I think the main takeaway is that for multi-asset portfolios of different flavors, long and short volatility can play a part. And it depends what type of multi-asset portfolio you're talking about, whether it's a long-term strategic portfolio or a more medium-term long-only target return, or even a more tactical long-short target return, that you're going to be interested in different types of volatility positions for those different types of portfolios. Well, so we do a lot of scenario analysis, and it's a core component of our investment process. And the one scenario really for most multi-asset portfolios is exactly that, where you have both bonds and equities selling off at the same time. So it's one that we keep constant checks on, and really it is very hard to hedge against that risk. But it's when that portfolio diversification, that natural diversification that bonds offer to a predominantly equity portfolio fails, that you need other options. So that's when we do start to increase our option protection. For the target return fund, that is my main focus. Really, we'll tend to take delta 1 positions and actually change our asset allocation. We are nimble enough that we can rotate the portfolio quite quickly, rather than any systematic hedging of the portfolio. So I think it's it's on a case-by-case basis, and for the target return portfolio, we have a drawdown constraint, so there is some path dependency to the choice of protection that we take. But we not only use equity volatility, we also actually have a number of positions in fixed income volatility. So we do like taking long volatility positions in rates. There are a number of structural imbalances there that mean that we can be slightly positive carry and still have a long volatility position in other asset classes where that's perhaps less possible in equities. So we like vol selling. We think the volatility risk premium is one of the few real risk premiums out there that is sustainable and tangible from both a structural and fundamental viewpoint. Having said that, in our target return fund, where we do have an alternative risk premium sub-portfolio, we don't actually include short volatility there, mainly because from an overall portfolio context, there is a reasonably high correlation between that and other sort of large risks that we have in the portfolio. And that, in combination with the drawdown constraint and target that we have, mean that it's not necessarily appropriate for us to add short volatility. We do, on a tactical basis, sometimes have short volatility positions, but not in a systematic fashion. So it came up a lot in the discussion just now, but the dispersion, I think, is an area of particular interest for us. It's not like it's a new type of strategy, but it's perhaps a little bit more accessible to investors like ourselves now, and we do feel that could well be an interesting avenue for us to pursue further. It's possible, and I think it is time variant. But the point I made there is go back to the fundamentals, that as long as there is demand for downside protection and there is skew in the volatility surface, then I think that volatility risk premium will persist. Well, so I came for the first time last year to Ireland, and I found I came away with lots of interesting ideas and contacts as well. I think it's a great place to get like-minded, both buy-side and sell-side participants in the same place at the same time.